Well, our attention now turns to unit trusts. The big question is, does the unit trust industry need a fee structure makeover? And joining me now from our Cape Town studios is Nick Brummer, Director at investonline.co.za. Nick, thank you very much for your time. Let's start off with the fee structure that currently stands for the unit trust industry. Do you think that it's looking too high at this stage?
Hi, thanks for having me. I think it's very relevant at the moment, given there is cost pressures on all different industries. Certainly at this stage, if you go and look at, there's two parts to it. One is on the asset management side, and then the other part is really on the broker side. And on the broker side, there's huge scope for cutting fees, and certainly that's why we've launched this new product, investonline.co.za, which is really a much cheaper avenue to go into unit trusts with advice still. But I think on the asset management side, there also has to be a look at some restructuring there. I think the issues to be questioned, there are performance fees in the unit trusts, different classes of unit trusts, and also layering of fees as well. So all of that, I think, is under the spotlight, and certainly I think there is going to be more and more pressure for the overall fee structures to come down.
Give us some indication of what the fee structures look like right now. So if you had to buy into unit trusts, what kind of fees would you be paying?
Well, generally you're paying an asset management fee anywhere between 1.2% up to 1.7%, and that's with VAT included. Some of them do have some performance fee included as well. Then there's also a platform fee as well. And thereafter, then there's a broker fee, and those broker fees are IFAs and tied institutional brokers, and they charge anywhere from upfront fees of 2% to 5% initially, and then an annual fee anywhere from call it 0.5, where we are at investonline.co.za, and 1.5%. So those annual fees essentially can come up to around about 3% or just over 3% on an annual basis, which really erodes your overall performance.
Well, you said there's a lot of pressure that we're seeing right now for asset managers and, of course, for stockbrokers to lower their fees. Do you see that happening in South Africa? And tell us what's been happening on the global front as well.
Certainly. It's under pressure. It's an economy of scale thing. So, globally, fees are slightly less. And in SA, I think what's really brought the attention onto it as well has been the absolute proliferation in unit trusts. They've almost doubled over the last 5 years, number-wise, up to 904 different unit trusts. And now, there's been comparisons made between average unit trust performances versus ETFs, which is not really a strictly comparable issue, but this is another issue we can discuss at some stage. So yes, there's no doubt. With the average unit trust not performing that well over the last 5 years, they really are in the spotlight right now. But I would like to say that the premium branded unit trusts have performed fairly well over the last 5 years.
And I think,
so I still believe there's a strong place for unit trusts going forward.
Nick, well, just to pick up on that point, because it seems that exchange-traded funds, or ETFs, as you alluded to, are starting to take a bit of the market share. And one of the reasons that they have is, of course, because they are cheaper and they're easily accessible, and the person at home can embark on investing through ETFs. How do you see that playing out? So if unit trusts, the fee structure is not looked at, and we don't see the fee structure changing, do you think that ETFs will become more popular here in South Africa?
Listen, I like ETFs. There's no doubt there's a place for ETFs. But I think a lot of times people don't realize the risk associated with the ETF. ETF, you're getting a direct exposure into the equity markets, versus a unit trust, you're getting an asset allocation with an expert looking at it, versus perhaps even a balanced fund. So it's not a true comparison to look at overall unit trust versus ETFs, for starters. Secondly, cost-wise, ETFs, there's a tracking error in it, and that's what you pay for. And that can range anywhere from 0.4% to 1.5%. And that's an ongoing cost, which is going to be there. On top of that, then there's also a broking cost as well. And that broking cost could be, on an annual basis, anywhere from 0.5% closer to 0.8%. So, cost-wise, a lot of people forget about the cost you pay for actually tracking that actual index going forward. So certainly it is cheaper if you do want to do a direct comparison with a unit trust, but then again, you're buying a different class of risk versus an ETF and a unit trust.
That's interesting,
again, mainly
Nick.
because a unit trust, you've got an expert actually looking at your asset allocation through the process.
Nick, that's interesting because I've heard that ETFs are relatively safe, that there isn't much risk attached to it. And apart from that, when you see here in South Africa, ETFs haven't really gained a lot of traction. But we know globally, ETFs are becoming increasingly popular, especially the commodity-linked ETFs. And it seems that one of the reasons that investors are moving to ETFs is because they're trying to stay away from the fee structure that we've been seeing at asset managers and the asset management companies, so that they can just get direct exposure to certain things. So what you're trying to tell me actually is the retail investors sitting out there watching the show, that unit trusts are a safer bet than ETFs.
I mean, I do believe that, and I think the key issue here is that there's no risk. When you buy an ETF, you're buying a direct. Essentially, it's like buying a share, but you're buying a portfolio of shares. And you're going to buy that share, and you're going to buy it at a particular level, and you're going to sell it at a particular level. And that's your decision when you're going to do that. So if the retail investor out there believes that they're an expert, and they can just go and they decide on the timing when they're going to buy a share and sell a share, or buy the index and sell the index, that's fine. Then they must realize that that's a particular risk that they're taking on themselves. However, when you buy a unit trust, you put in that decision in the unit trust management manager, and they're making that decision when to buy that share and sell that share. So if they believe that the market has a high potential to come down, they're in a position to reduce their overall exposure to equities significantly, where if you're in an ETF, you're just going to hold it and you've got to make that decision yourself.
It's a tough decision, I would say. Just looking at how unit trusts have performed relative to the equity market, give us an indication of what we've been seeing over the long term.
Well, yeah, over the last 5 years, the average unit trust has slightly actually underperformed. The average equity unit trust has slightly underperformed the index. But then again, we'd like to say that a lot of this is because there's been this massive proliferation from 550 to 904 unit trusts. But if you look at all the premium branded, big established, tried and tested firms out there,